What's going on? Welcome back. Ryan here. I'm so excited because in this video we're talking about the long call calendar spread and the long put calendar spread, which are time spreads. And this to me is easily one of the most powerful option strategies you have available to you because of the freedom you have in how you can adjust this and how much flexibility you have to produce consistent winners using this strategy. So let's start with the long call calendar. Okay, so again, here's Amazon, right? And if we think that Amazon is going to trade back up into this one standard deviation range, right? We could target this 3,500 strike. And the way that the long call calendar works is this, right? So we're buying a call, and we're buying a call that has, let's say, we'll look at this February 18, okay? And we would buy this call, right? For instance, we'll buy this call. So here it is. Here's a single buy, right? One Amazon, February 18th, 22, 3,500 strike call, right? And let's say that we did it for 128.50 cents, right? So the price of this is $12,850 for one of these options, right? And what we're going to do now is we're going to come in and we're going to spread the time difference, and we're going to sell a short-term call with the same strike, right? So what this looks like is, so we have this February 18, and then we'll come in here to this January 21st, and again, we'll come in here and we will target this 3,500 strike, except this time we're going to sell this shorter term option. And the idea here is, as Amazon moves towards our strike, that back option is getting juiced up with value, and the front option is also getting juiced up with value, but the front option is going to lose theta, right? It's going to lose theta. It's going to lose, the premium is going to decay on that front option faster than our back option, which is where we're spreading that time, right? And because of the passage of time, we are then going to be able to make money on this trade, right? So even doing this trade, though, we're still looking at a very hefty price tag, right, for this type of trade. And when we click confirm here, it's kind of hard to estimate the profitability of these calendar spreads because we don't know what's going to happen with that front option, right? So the way this looks is, when we actually analyze this trade, it looks something like this, right? Where, again, it's a defined risk trade, right? We can't lose. There's no unlimited risk, right? But the way that this works is, as the passage of time continues, again, we have the intrinsic value at expiration, and then we have our time value that's moving towards that intrinsic value at expiration. Now, the reason why I love calendar spreads so much is you can make money with them as a directional play, but you can also make money with these when the market is stagnant and moving sideways, right? Where, for instance, if, again, with Amazon, if we thought it was going to go up, we could actually do this a couple different ways. There's so much flexibility with these calendar spreads, right? Because one idea is you buy the long-term call, and then as time progresses, you sell every one of these contracts as it progresses forward, right? So you could make money from selling these, you could make money from selling these, you could make money from selling these, and you actually don't have to have the strikes be exactly the same, right? Think about it. If we bought like the 3370s here, right? We analyze this trade. So here's this 3370, and then we come in here and we want to analyze what it would be if we sold, right? We'll delete this. So we're long the 3370 with more time, but now we want to sell kind of an out of the money option, right? Maybe this 3450, so we would sell this, right? And now we can analyze this trade. So again, important to understand that when we're looking at these trades, like for whatever reason, this is not actually showing us what's happening here. I'm not sure why. Sometimes with the calendar spreads, it can be a little finicky the way that we look at it if we don't put the trade in together at the same time, right? So for instance, when we come back here, we'll do this again. We will buy this 3370, and then maybe we again sell this one. So now it's calculating this as what's called a diagonal spread, right? Time spreads are diagonal spreads because we're spreading the difference in the expiration dates, right? We're buying that long-term option, we're selling that short-term option, and we're hoping to profit from the decay of that front-term option relative to the back option. So again, I've put together this diagonal trade here, and I guess this is correct. I guess it looks like purely a long call almost, right? Where we've bought the February, we sold the January, but you know what happens is if we delete this, right, and we come back in here, and instead of doing it diagonal where we're buying the long-term option that's deep in the money and then selling one kind of out of the money, right? When we look at this, the way that produces that classic calendar spread graph, right, where we're buying this at the money 3400 and maybe we're selling this at the money 3400 with less time, right? These have the same strikes. So yeah, very strange. I wonder why that's happening. Oh, that's why. That's why. So I had very important, because what happens is when the date inside of this little field here is ahead of the option expiration, it's just going to show. So let's rewind. So let's go back to the situation where I had originally, I bought, right, we're looking at this 3370 in the money, 58 days, right? So I buy this and we'll analyze this trade. Okay, here it is. And now what we're going to do is we're going to add to this that short-term position. So we'll go 9 days out this time. Actually, let's just look at this. We'll sell the one with 1 day, right? So because this is premium we could capture, right? Right now we're long the 3370 call on Amazon, right? 58 days to go. And now we want to come in here and sell this short-term option, right? So maybe we think Amazon is not going to get up to 34.50, and we sell this option for a credit of $11. We'll just do one of them. and now we add that, right? So this is the correct graph. And what was happening before is as we cycle through the time, see that? Once that front option expires, this graph then turns into that long call, right? So imagine you buy that long-term option, then we sell the short-term option. Amazon is going up, so the back option is gaining value. And now that front option expires worthless, and we keep that money, and now we still own that call on the back that's getting juiced up. And you know what this means, right, is we can essentially sell premium on the short-term options with little to no risk as long as we own these long-term options. And this is a great way to get into a security at a discount, right? Again, remember we could sell the put and get a discount on an asset that way, but we can also use the difference of time between option expirations, and we can use that to our advantage by buying the long term and selling the short term. So again, but here we look at the risk on this, and we can see that, right, we still have quite a bit of risk because this is a $20,000 option almost, the back one, right? $192.65 times 100 shares. That's $19,265. And on this front option, we would only be getting $11. So if we remove this though, and now we have our long call, right? Again, when we come in to this option chain, maybe we want to sell 16 days. Actually, we'll just go up. We'll do 9 days this time. Again, we'll target, again, that same 34.50 level. We're going to sell this, and we'll just analyze, and we will add it. Now, the reason why it looks like this is because the ratio is off. So once we put that back in alignment, again, we're going to get that same type of graph, right, where as time starts to move forward, you know, we can make money if this market doesn't move. And then again, if this short option expires worthless, we still have this long call that can be making money in the long term, right? So again, if we come back into this trade here and let's sell some more time, right? We originally we were long this February 18th, right? 30, what was it? 33.70, right? And now let's do 30 days, right? So we could come in here and we could say, because remember, look, there's a lot more premium that we could sell here, right? So maybe we think it's not going to get above 34.30, so we sell this option, right? And now, again, we'll just do one contract, right? Make it even, and we'll analyze this trade. And again, right now we're only, our downside risk to the downside is only 9,600, and to the upside, if it runs away from us, it's 3,600. And again, remember, these calendar spreads, you can put them above and below the market with calls and puts, right? And as this time passes, this front option will erode away, and we could then keep that money and still be left with the call, the long-term call. Okay, so that was the call side. And again, I think that the put calendars are even better than the call calendars, because these calendars, they're very sensitive to Vega, right? When a stock drops significantly, right? When the value of that stock drops significantly, you can have an increase in volatility. And a trade like this, where you would have like a long put calendar, could be very lucrative, right? So again, let's think about another scenario. Let's say that we still think that Amazon is going to go up, but we only think that Amazon's going to go up in the short term and then it might go back down, right? So for a trade like that, right, think about, we think that Amazon is going to go up, right? So, but we also think that it could at some point turn around and go back down. Well, that would be a perfect scenario to use a put calendar spread where we actually put this on in the money. So think about this, 58 days out, right? February 18th, 22. And now what we do is we buy this $3,500 put in the money, right? We're going to buy this and we're going to analyze it, right? So here's our put in the money. And now what we're going to do is we're going to come in, we'll remove this, and now what we're going to do is we'll sell this January 21st. We'll sell the same one. So we'll sell this in the money put, right? And what we'll do is we'll analyze that trade. And now, right, we have this similar trade where we have our defined risk on either side, but now we're selling, right? We've put this put calendar on in the money, right? So think about that. As this market moves up, right, the back and the front option are going to be losing value, right? But in this payout here, we're actually making money, right? So if we come back here to where we are today, which is the 21st, right? So imagine Amazon starts going back up, right? Time is ticking away, right? And this option expires on January 21st. So if this is below 3,500 at January 21st, right? Let's say it's right here, 34.82, right? We would keep all of this money, right? And then what would happen is this would go away, right? This would go away, and we would keep that money on the short put. And now we still own this put that has time value left, right? Because it's a longer term option. And if we were correct in our assumption that the short term gain on Amazon was limited, well, if Amazon turns around and tanks, right, this put that we have would easily be in the money, and we would not only keep the money that we got for selling that short-term put, but now we would still have our long-term put, and if the market accelerated downward very quickly, this put would be in the money. Volatility would be going up, which would increase the price of this, right? And this could turn out to be a huge winner, right? Now, again, when we talk about calendar spreads, the reason why I like this trade so much and the reason why I think it's such a lucrative strategy when you really understand what you can do is when we start to understand where we lose money when things go wrong using calendar spreads. So I'm going to bring up the Spider ETF here. And again, we're going to just think about calendar spreads, right? So again, the Spider has made this move down into, this 2 standard to 3 standard deviation range. And now it's going back up to the mean, right? Maybe it'll come up and make new highs, whatever it does. But just understand, for instance, if we were to assume that the SPY is going to make a new high, right? It's going to break above this last high, and we wanted to target this 470 level, right? Which is about $7 away. We're $7 out of the money. Maybe we even want to go more, 480. We're really bullish. We think it's going to get there, right? So we come in here, and again, let's look at February 18th, right? 58 days away. And we're looking at the 480 here. So we buy this 480 and then we'll analyze it, right? So here's our call. Here's our long call, right? And again, we have to reverse this time to get us back to where we are today. And so we'll just do one of these. Now, when we add the short-term option, right, where we're turning this into the calendar spread, let's say that we do 58, 24, right? So we'll do 27. We'll do the same January 18, and we will sell this front option. And then again, we have to make them even. So here's our calendar spread, right? We're risking $346 to make $490. Well, how can you lose money on this? Okay, well, you're going to lose money if the market tanks. You're going to lose money if the market runs too far, too quick up here. And we just want to understand what that actually means. So remember, we're selling a call here, which means if this asset expires below 480 before January 18th, we keep that premium. Now, what happens if it's above 480 at expiration? Well, on that front option, because we sold a call, we would then be short 100 shares of this SPDR ETF. Now, the reason why this is important is because even if you are assigned on this short call in the short term, you still own that back call, right? And because it's at the same strike price, it's like having insurance, which means, for instance, if you have the margin, right, you're going to need the money in your account to be able to take delivery of this short 100 shares of SPDR. If for whatever reason the security goes up, you get assigned short 100 shares, SPY could turn around, right, and get smashed down, and you could buy those shares back and you could make money there. And you could still, again, own that call on the back end, which, again, right, we could then turn around and come back in here. Remember, we only sold 27 days away. So again, we have more options we can sell. So we could then come in here and sell another call, right? So again, we could come in here, sell another call, and start this process over again, right? That's the beauty of these calendar spreads, right? Is that you have so much flexibility to be able to adjust, to be able to add options, take options away, sell more premium, things of that nature. Because there's so many things that you can do, and because obviously there's no guarantees, and we don't quite know how the market is going to respond. And because I love this strategy so much, a few days ago, I put a trade on just as an example to look at, right? So here is this. Here is the S&P 500 futures, and right here's my trade that I put on, right? So I put this calendar spread on my simulated trading, and I did 25 of these, right? So the risk on this trade was $27,500, right? And now at this very moment, with where we are, this trade has already produced a winner, right? So if we come into here to my monitor tab, we can see that this position is up $6,500, right? So if we look at the trade price now, if we look at the actual math and see what's happening here, right? I purchased an option for $33.50, right? And remember, this is the S&P 500 futures, so that's a 50-point multiplier. So $33.50 times the 50-point multiplier gives us $16.75 per contract times 25, right? So $41,875 is the debit that I had to spend for these options. And then on the sell side, right, $11.50, right, times that $50-point multiplier gives us $575 a contract times 25 of them, which means I took in a credit of $14,375 for these front options, right? Which means my total cost is $33.50, right, minus the $11.50, right, which gives me a price of $22. This is a $22 spread. So my risk is, right, 22 times the 50-point multiplier times 25, right, which gives us that $27,500. Now, when we look at what this is worth now, we can see that the back options are worth $41.75 minus the front option, which is $15, right? So we can see that this spread has widened, right? And we have now made money, right? Because this spread is now worth $26.75, but we only paid $22 for it, right? So $26.75 minus the 22, that means we're up $4.75 times the 50-point multiplier gives us $237.50 per contract, right? So times 25 of them, and that gives us, right, exactly what it's saying now, which is $5,937.50, right? And, you know, for example, if I wanted to close this trade out, I could control select both of these, right click, click create closing order, and sell 25 of these calendars, right, at $26.75, right? So maybe, so we'll try. I'll hit confirm, I'll hit send, and boom, it sold, right? So now it shows, right, on the day I made $625, but when we actually look at all the accounts, we could see that I have a profit here of, you know, close to that $5,900 or whatever it was, right? And I put that trade on 2 days ago. And obviously, this is simulated trading, right? It's a $200,000 account, right? I'm not saying that anybody should or would be using, you know, a 25 lot on account this size, but just for the sake of example, it's really important to understand just how fast and how quickly these trades can be profitable with whatever type of risk profile you want to use. Okay. Now, again, like I was saying before, all of these different strategies have certain scenarios that can become iffy, that you need to understand assignment and what that means. But again, when you understand the spreading of time, it can become very easy to make money this way. And furthermore, you know, I love these calendar spreads because it really forces us to be disciplined, in the sense that when we're choosing these calendar spreads, we're most likely buying longer term options, right? Which, if you were just buying options outright, it's probably what you would want to do anyways, right? Which is to buy more time, and then once you have that longer term option secured, well, then you can start coming into these shorter term options and doing all types of different things based around the fact that you have that long term insurance. Okay, so I highly suggest that you ask questions, you reach out. When it comes to all of these strategies and just how much information there is, this is why I recommend one-on-one coaching, right? Because you really can get your specific questions answered, right? We also can get on a Zoom call and look at the market in a live scenario with real money, and I can do an example trade, and you can watch, over a series of several days or several weeks, just exactly how I manage that risk, how my thought process works, and how I'm able to, create income using these strategies, seeing firsthand how I actually do that. Right. So again, I highly recommend that with all of these strategies, you come into Thinkorswim, you use the simulated paper trading, you put these strategies on, you see how they work. You don't be too anal about the fill prices, the actual risk quite yet, right? Obviously, when you're trading with this paper money, we don't want to be so unreal where we're just betting huge amounts of money, right? You kind of actually want to paper trade like you would with your real money, see how the options respond, see how the market responds, and get comfortable with getting in and out of these positions, knowing how they work, knowing how to look at the risk. This is the most important part, right? Again, that we build confidence, that you're doing this in a safe way where you can practice before you go into battle and use real money. So again, love calendar spreads, extremely flexible, and I highly suggest that you look at these, you practice them. Again, ask as many questions as you can. I'm always here. And as always, I will see you in the next video.